Every week, I get calls from investors who set out to do the BRRRR method and then they hit a wall once they do the refinance, because what happens is there's not enough capital to pull back out of the deal to get the next one started. And at 2026 rates and pricings, that's on most deals right now. So what do the actual investors do to do this full time? What do they do instead? Most of them run a strategy that nobody really talks about. It's called the 3-in-1 method. It's a harder sell as a YouTube course, but it's what actually builds portfolios in a high rate environment. In the next 8 minutes, I'm going to show you exactly how it works, the tax play most investors miss, and how many cycles it takes just to walk away from a W-2. I'm Robert with OpenLane Funding. Let's get into it. The 3-in-1 method is a 4-deal cycle, and here's the structure. Deal 1, 2, and 3 are fix and flips. You buy distressed properties, you renovate them, and then you sell each one for a profit. You stack the after-tax cash in a business account. You do not deploy it into another flip. That cash has a job. Deal 4 is your keeper, right? You use the stacked cash from the first 3 flips as a large down payment on the rental property, or you buy it outright with a small DSCR loan on it after closing. The point is that your keeper has significant equity from day one, financed largely with cash, not leverage. Then you go back and then you start the cycle again. 3 flips, 1 keeper, 3 flips, 1 keeper. Every cycle produces you 2 things: spendable cash from the flips profits and new cash flowing on the rental that you're going to hold forever. Now, the active side pays the bills today. The passive side compounds towards retirement. Now, here's 4 reasons that this strategy is winning in 2026. Reason number 1, no BRRRR refi risk. BRRRR is completely dependent on the cash out refinance returning enough capital to fund your next deal. If the appraisal comes in low, which has, depending upon where it is, there's a good likelihood. If rates spike, which there's so much volatility right now in the market, if lender guidelines change, if the whole cycle stalls, the 3-in-1, it doesn't care what the refinance market looks like. You're funding your next deal with cash from the sale, not equity from a refinance. Reason 2, you're not maxed out on leverage, and every BRRRR property sits at 75% LTV, the day you refinance. Every 3-in-1 keeper starts with a 40 to 50, sometimes even 60% equity in a soft market. And 3-in-1 investors sleep at night, right? The BRRRR investor is still watching the Case-Shiller every Tuesday. Reason number 3, better keeper cash flow from day one. A property bought with mostly cash and then financed with a small DSCR loan produces meaningful monthly cash flow starting immediately. A BRRRR property at 75% LTV is typically a break even or barely positive at the 2026 DSCR rates right now. Real cash flow from property 1. So reason number 4, optionality on future assets. If rates drop 100 basis points in 12 to 18 months, the 3-in-1 investor can refinance their keepers into cash out loans and BRRRR them retroactively, meaning the BRRRR investor is locked into today's rates on every property they've already refinanced. In most cases, they're closing with a 5-year prepayment penalty that is going to penalize them if they refinance within 5 years. The trade-off is speed. BRRRR is faster if it works. The 3-in-1 is more reliable when it doesn't. Now, comment 3-in-1 below and I'll send you the cycle calculator that walks you through the 4-deal math with your own numbers. And subscribe, because next Wednesday I'm going to be going to a deep dive on the buy and hold with turnkey rentals. That strategy for W-2 investors who want to start real estate without becoming project managers. Now, let me put this into numbers, all hypothetical for illustration only. Assume a 400,000 ARV market. Same math as our flip deep dive, right? You buy a property at 70%, you minus rehab, you put 50,000 up for renovations, and then you hold for 9 months, and then you sell at ARV. All in cost is around 290,000. You sell at 400,000. Your exit cost is at 3%. Listing plus title runs about 18,000. So your gross profit is going to be running around 92,000. Now, if it's held under 12 months, your tax combined about 35%. After tax, you're netting roughly about 60 grand. Flip 2, same numbers. You're another 60K after tax. So now you've got about 120. Third flips, same numbers. But this time you optimize for taxes. You hold it past the 12 months. For an extra 2 to 3 months of carrying cost, you're going to, which is right about 6K worth of interest. But the tax treatment here is now going to change. Held over 12 months, you're going to have profit that converts into a long-term capital gains at roughly 20% federal instead of 35% combined. Now, after tax net means that on flip 3, you're going to be roughly about 76,000 minus that 60K. So you're going to be about 10K ahead of where you were. So 70,000 clean about. That puts you at a combined total of 190 grand. Now, deal 4 is where your keeper comes in, right? Because now you got $190,000 cash. You go find a property that will rent well long term. You purchase price, let's just say around 350,000. You put down 60%, 210 grand, financed with a $140,000 DSCR loan at 40% LTV. But wait, that's more cash than you have. Let me redo that. Let's say purchase price 350,000. Let's say you put down 175,000. That's roughly about 50%. Now, financed, with a DSCR lender, the other 175,000, you still have $15,000 in reserves. Exactly what the lender wants to see. And you can even play around with those numbers to see, okay, you want to keep 40K in the bank so you have enough to start on the next one. Guess what? You still have 190 grand. However you play this, there's a lot of different ways, right? Monthly cash flow on the keeper. Let's say rent at $2,600. Okay, your mortgage payment on a $175,000 DSCR right now is going to be about $1,300. Taxes, insurance, maintenance reserves, plus some property managers. So say $700 for the combined. So now your net cash flow is about $600 per month, or $7,200 a year. Now the cycle starts to repeat. You start flip 4 with a fresh capital from a small business line for credit or private money, or you can go find a money partner or however you do it, or maybe you just leave that 40K still sitting in the bank so you can translate that into another flip. Now you run the same 3-in-1 and the second keeper 18 to 24 months later. Now, the keeper is where the whole strategy either wins or fails. 4 criteria for a great keeper. Number 1, strong long-term rent trajectory. Look at 5-year rent growths in the submarket, not just what the current rents are. A property in a market growing rents at 4% a year for decades doubles its cash flow over 20 years without you doing anything at all. Number 2, low maintenance profiles. New roofs, updated systems, new deferred maintenance. Every dollar you spend on maintenance is a dollar out of your cash flow. For a keeper, boring and reliable beats interesting and complicated all day long. Number 3, strong location fundamentals. Growing employer base, low crime trajectory, good schools if it's a single family, easy commute, if it's in a workable workforce rental. Location determines tenant quality, which determines cash flow reliability. Number 4, fits the market that you're already working. If you're flipping in Spokane, buy your keepers here in Spokane. You know what the submarkets are. You know the tenant pool. You know the contractors. Don't diversify into 3 markets while you're building the first cycle. Diversify later in your investing career. Now, what do you want to avoid? Vacation properties as your first keeper. Management is complex with those. Premium properties above the neighborhood median, weak DSCRs. Rural properties without strong rental demand, and properties that require significant capital expenditure in the first 5 years. Now, here are 4 mistakes that I see that break the 3-in-1 cycle. Number 1, deploying the first property's profits into flip number 4. The whole strategy depends on stacking cash for the keeper. If you use profits to run more flips, you're just a flipper. Discipline on where the cash goes in the entire game. That's why if we're talking about it, right, we're only holding back, if we go back to that 40,000 mark, you're only holding back a very small nugget. And then you can still deploy $140,000 to $150,000 for a down payment. That's massive equity into your deal. Number 2, buying the keeper before you have the full cash. Impatient investors buy the keeper after the 2 flips, and then they take on a bigger loan. That defeats the purpose. Then you're basically running a slower BRRRR with worse cash flow. Complete the first 3 flips before you go into the hold. 3, choosing the wrong keeper. Emotional buying kills more 3-in-1 cycles than any other mistake. The keeper is a 20-year decision. Take your time with it. Walk 30 properties if you need to. Run the DSCR on all of them. Pick the best one, not the first one. 4, no tax plan. The flips are ordinary income. On 180 grand of flip profit in 1 year, you could owe 60,000 to 70,000 in taxes. Set the tax money aside at every closing. Do not touch it. Do not deploy it. It belongs to the IRS. Put it in its own bank account so you don't even have to see it in your regular investment accounts. Investors who forget this rule get destroyed in April. Now, here's the math investors actually want to see. So let's assume 600 monthly cash flow per keeper, is similar to a hypothetical we walked through. To replace a 6,000 monthly W-2 income, you need 10 keepers. At one cycle per 18 to say 24 months, 10 keepers is going to take you 15 to 20 years. Now that sounds slow, and it is, but you're also flipping the entire time. So you're generating 150 to 200,000 of active income per year during the build. You're not sacrificing today's income to build tomorrow's. You're doing both. For most investors, the goal isn't a full replacement. It's supplementation, right? 5 keepers producing 3,000 a month at a passive cash flow combined with 3 flips a year of active income. Now that is a real career. That's achievable. In 8 to 10 years of disciplined execution, and every keeper that you add gets easier. The cash from earlier flips, they start compounding. Your rental income covers your living cost. By cycle 4 or 5, you're deploying flip profits from a position of financial security, not scarcity. Here's the bottom line. The 3-in-1 method is not the fastest strategy. It's the most reliable one at the 2026 rates. There's no refinance dependency. There's real cash flow from day one. Optionality if rates change. Active income paying bills while your passive portfolio compounds. So comment 3-in-1 below and I'll send you the cycle calculator. If you're trying to figure out whether the 3-in-1 fits your situation or which of your local markets is the right keeper, call or text the number below or in the comments. I'm Robert with OpenLane Funding. I'm going to see everybody on Friday. Have a great day.